Stock market is having an absolute bloodbath right now. NASDAQ is down more than 5%, the biggest single day decline for the NASDAQ since 2020. And on top of that, bond yields are surging. So remember, the way the bonds work is that when the yield goes up, the price or value of the bond goes down. So normally what happens when the market's crashing is that yields go down because people buy bonds as a safe haven. So that's what's so crazy about what's going on right now, is that there's nowhere to hide except cash. The S&P is officially down year over year. Treasuries are skyrocketing. They're the cheapest they've been in about 3 years. Wow, look at that. In live time, we're about to break through to potentially a 5-year high on the interest rate. See, now the economy just cannot handle that. See, keep in mind, this is the interest payment on the $30 trillion of debt that we owe. The course of 6 months, our interest payment went from $500 billion roughly to $1 trillion, because it went from, about 1.5 over here to 3. And we haven't even started quantitative tightening yet. Remember, quantitative tightening is when the Fed stops repurchasing its bonds after they mature, because the only thing the Fed started doing here is they stopped acquiring more bonds, but they were maintaining the same amount they had. Now they're going to start letting them roll off their balance sheet. So let's look at an all-time chart to get some perspective, because from an all-time perspective, this isn't a big deal, but remember, it's a bigger and bigger deal what the rates are when the debt's higher and higher. So that's why so much effort has been put into suppressing this interest rate. Same thing with stocks. When you look at a 5-year picture, it's a much different story than a 1-year picture. It's still up 71% over the past 5 years. The thing you got to wonder now is, what is the floor once it starts falling apart, and does the Fed get involved? Two big unknowns.